Welcome to the Beginner Small Account Training Group for June 14th, 2018. Aramir, who hosts this event, is not a broker-dealer or a securities investment advisor. I am also not a broker-dealer or securities investment advisor. And so we are not making any specific trade recommendations here in this session. Everything you see in here is for educational purposes only. Options involve risks, and you always trade at your own risk, and past performance is not indicative of future results. Okay. Now I can close that one. Let's see here. Great. Okay. And I do have figures on running. Oh, okay. Ready to go. Okay. Great. Well, today I thought that I would talk a little bit about doing a covered call on Amazon as an idea. I'm not doing it personally, but I might. I'm thinking about it, but I'm not sure what I'm going to do, and show you a couple alternatives. I haven't even looked at my covered calls, but if I look at the stock prices, which I have in my watch list here, they're all doing well, so I know I don't have to look at them. This one, Campbell Soup, is pretty neat. I'm real happy with this one because if I show you my simulation of it, it looks like this. Now, Campbell Soup is a pretty stable stock. It's got a beta of 0.33 and a decent dividend rate and a decent dividend. So I did a cash secured put on it when it was at, sorry, I have to look that up, 33.64 on May 31st. Well, that was about here. And you can see now the market, it has gone all the way up to 36.51. I actually wish I'd bought a whole bunch of shares because I made more money on the shares. But anyway, I sold the July 32 put for 78 cents, which I thought was a decent profit. And if I was to buy them back right now and close this trade, I could do it for 25 cents. So I could close this trade right now and have a decent profit for my 2 weeks in the trade. I think I'm going to wait a little bit longer, see if it gets better, and at that time we'll consider if I want to roll them up and in, or just get out of Campbell Soup altogether. Might not be a bad stock to own either, but I don't have plans to own it. So that's Campbell Soup. Anybody have any questions about anything we talked about last week, or anything in general, or anything at all before I go into Amazon? Okay, so I thought I'd talk about Amazon for a few minutes, just some ideas and things to look at if you were going to do this. And then I thought I'd go through my presentation, which I called Building Strategies from the Basics. And I might have done this presentation a year or more ago in this group, and I know I did it a couple years ago in somewhere else. But I think it's all good. It's all good information, and I wanted to get back to the basics a little bit with you. And so we'll go through that after we talk about Amazon. Well, Amazon is a $1,723 stock, which means that if you were to buy 100 shares of it, you would be spending, $172,450. Now, unless you're worth hundreds of millions of dollars, that's a lot to put into one stock that essentially has no dividend and has a high beta. That'd be a really risky thing to do. But because of that, it has options that have pretty good premium. I mean, if we look at the options that expire a week from tomorrow, and you go look at the calls, they're near the money. We've got premiums in the $18 range. That's $1,800 for one contract if you could collect that premium. And that could be really attractive. But $1,800 on 172,000 is about 1% in a week. And if you did that 52 weeks a year, you'd have a 54% return on a covered call strategy. I bring this up because I met somebody who was doing this, but they weren't aware of their risk. And the risk is when you own the stock, it can go down. Yeah, it can go down. If Amazon just went down, let's say 80 points, just from the stock, you'd be down almost $8,500 if it happened today. This is a high stakes game. So the question is there some other way to collect that premium on these near the money calls, this high premium, that is safer and uses less margin and less money? And two things come to mind, and I want to talk about them briefly here. The first is to do a synthetic covered call, which is where you would sell the call you want to sell and buy one further out in time and lower in strike, which means it'll be in the money. And I'm going to just build this manually. I'm not going to try to use a template. So let's say we're going to do this one, the 1725. It's the at the money option. We have $18.20 premium. I'm going to just model selling that. Now for buying a call to cover it, we go find a deep in the money call, and I usually would say, if you're going out a month or so, you should look for 80 delta, all right, on your call, or some high delta. If you're going out further than that, you can look for 50 or 40 or 50 or 60 delta, because it has more time and less wasting. Well, an 80 delta call on Amazon would be this one here. It's going to cost you $11,175. Now, this is much less than 10% of buying the stock outright, but it's still a very expensive option. Now, the dynamics of this might be worth it because you can make $1,700 on an 11,000 or so investment. That's 15% a week. That's even more attractive. So it might be something that you would decide to do. But I want to look at the graph a little bit here and show you some graphs. I can clean this up. This is what a synthetic covered call looks like. As opposed to a standard covered call where you buy the stock, it has the upper expiration line going out flat up to infinity. But because you have a long option that can waste a little bit and has a certain strike, and it has less delta than the stock does, it makes this line curve down a little bit. So synthetic covered calls always look like this. But how much it tilts down, you can control. Let's say I didn't want to buy an $11,000 option. I wanted to buy something cheaper. Like, let's say maybe only $5,000. So do we have one in the 50 range? That'd be about right here, 1715. If I change that to 1715, now we're spending just under $4,000 net for this position. But notice how it changes the graph. The closer you get the strikes, the more it starts to look like a calendar. And in fact, if the strikes are the same, it would be a calendar. You're selling a near one and buying a far one. So just to vary it on the graph, if I go down to 1700, you can see this is starting to rise and this is tilting. The whole graph is tilting down here and up here. But it costs more. watch the Greeks while I do this too. There's differences in the Greeks, delta and vega. I'm going to go down another 50 points for this long call. We have less positive vega here, and we have higher delta. Okay, but we're getting more and more towards the traditional covered call graph. So it's a matter of choosing the graph that you want, that's wide enough to have a good profit range, that has a decent downside protection, and how much margin you want to put into it. These things are all trade-offs that you can do. I also want to show you the effect of varying the month in which you buy the long call. Here's one, 20 July. It's a month out from the short. Let me change that to August and watch the graph. Now it's starting to get back to looking towards the calendar. And if I go another month, September, even more. Okay, so we have a less of a range of profitability to the upside, and we have similar break even to the downside. I didn't really look. Your vega gets more and more positive. Okay, this essentially is a diagonal when the strikes are different, because my long is a lower strike than the short. Okay, so if you took this to the logical extension, what if you just bought an option that is only a week out from your short? See how much it looks like a standard covered call if I do that. Maybe I can get the strike back up a little bit and start saving saving margin and still have a reasonable profit target. This doesn't look bad, you know? This doesn't look bad here. As long as you know you only have about 15 points to the downside break even at expiration, and less than that to the downside, and we start to have drawdowns really fast, just like you do when you have a credit spread. Okay, so those are all things to play with if you're putting together a synthetic covered call. But it can save you a lot of margin over buying the stock. And so any stock that's over maybe 100, I would do it as a synthetic if I was doing covered calls. Anything below that, or maybe below 50 or so, you know, the stock is not too expensive. You can just buy the stock and have a better position. One advantage of buying the stock is it never expires, and so you don't have this long option to expire. And that's a good point. When expiration comes up for your short, if you've done it as a synthetic call, I would recommend just closing the whole trade, because you don't want to take this long call into expiration, because you lose all its extrinsic value, which is high amount. It's better to get out. But if you do this as a covered call where you bought the stock, it never expires, and so you can sell one short, and if you don't get assigned, you sell another one. If you don't get assigned, sell another one. You can just keep doing it forever until you get assigned or decide to quit doing it. Okay, does that all? I hope that all kind of makes sense. I'm going to consider doing this, maybe a one lot on Amazon, and see how much premium I can get, but so far I haven't done anything with it yet. Now there's one more thing. Let's say that you like this position, and so you were going to make this trade. My microphone cord is getting rolled on by the chair. Anyway, let's say you're going to make this trade because you like the dynamics and the P&L and the margin and all that stuff. We can make a maximum of $946 at expiration if the price was right here, and unless we have a break even of 1710 and it goes up a bunch, we'll make some money, but not a lot. So somewhere between $0 and $900. Probably realistically, you ought to think about maybe $600 as your target, because then you have a wider range to realize it. Well, there's other ways to collect this premium from this 1725 call. Remember, that's the entire reason of what we're trying to do. We saw that it has, I'll go back to the right expiration, June 22. We saw that it had a lot of premium, and we said, I want to sell that premium and see if I can collect it. 1725, it has $18 extrinsic value, which is 100% of it because it's slightly out of the money. What else can you do if you want to sell that premium? First thing that comes to mind for me is call credit spread. So let's look at that. I'm going to sell this call and I'm going to buy one at a higher strike. How much higher? Well, let's buy it such that our margin would be about the same as it would be in this trade. So we have somewhere around 2,500 in margin on this trade when you net those two out. I guess I'll do the math here. 41.65. $2,370. So what kind of a call credit spread can you put together for $2,370 or so? Well, let's just start raising the strike of the one that we're buying until we find out. Now I'm up to 1,000. Let's go up to 1,750. I'm up to 2,500. I'm a little bit past where I was. How about 1,745? The answer is it's going to be somewhere in between these two. Sorry, 4,750. That's pretty close. Let's call that close. Now you can see that this call credit spread has a profit potential of $895. Not only that, but it has it in a very wide range from the price of your short all the way down to zero. Right? Not in just one little peak range where we had on the synthetic covered call. But it's to the downside. To the upside is where our risk is in this position. And anywhere above 1747, which is where our long strike is, at expiration you have maximum loss, which is $1,355. Reading that from over here. Okay. This might be as attractive or more attractive for you. We're using the same amount of capital. We have a wider range, although it is directional, it's to the downside. To the upside, we have a little bit of a range, not many points range till our expiration break even, and then we start to have drawdowns. But if you decided that your max loss was going to be equal to your profit target, say is $800, then you might say, if Amazon gets to about 1770, I'm going to close this trade and take the loss and go on. This could be a much more attractive way to sell that same premium on the 1725 call. So I just wanted to compare synthetic covered calls and call credit spreads a little bit, show you there's differences and advantages to both. Both are ways to sell at the same premium without having to buy the shares. And could be a viable strategy. Okay. Any questions about all that? Okay. Let me shift gears here and go into this building strategies from the basics presentation. And I'll go through it fairly quickly, but there's a lot of good stuff in here, and a lot of this is foundational knowledge or basic knowledge that you can apply to all of your option trading. You know, knowing this stuff will give you an insight into whatever you're doing when you're trading a particular strategy. Okay. I did this for when I was back in Sheridan, I guess August 2015. Okay. So I wanted to show graphically and explain how individual options combine into spreads and strategies. This is very important. because all a butterfly is a combination of 3 different strikes, all using puts or all using calls. I want to show you a little graphic about iron condors versus butterflies and how these things combine into one. The bottom line is you've got individual options like long calls or short calls and long puts or short puts. Combine them together, you've got verticals like credit spreads and debit spreads, and maybe even diagonals if you want to think about it that way. Combine verticals into strategies, and you've got iron condors or condors and butterflies. And they're all basically related. Okay, so I made this little chart, and I really think this is a cool chart. I like this chart a lot. It's a takeoff on something I studied in psychology back in college, but I think it was Maslow's hierarchy of child development or something like that, or I can't remember who it was. But here's the deal. If you look at how many people trade options on the bottom, you have everybody who says, I'm going to trade options, I'm going to go buy puts, I'm going to go buy calls. And they do that. And that can be a viable strategy, but it's speculation and it's directional. But the majority of people don't go further than that. If you want to have a PhD level understanding of options, you need to understand spreads and strategies and adjustments. So the next thing that people do, a fewer number of people will get into, is understanding spreads. Debit spreads, credit spreads, diagonals, and calendars would fit into this category. They're all spreads. Diagonals and calendars are time-based spreads, where you have an option in 1 month and another option in a different month. And then debit spreads and credit spreads are all in the same month, but different strikes. And a lot of people will stop there and not go further, and you can make a viable trading strategy to just doing spreads. But then I put strategies above that, which is like road trip, M3, bull spread, super simple spread, parking trade. All these things are strategies built around the basics of spreads and combination of spreads and puts and calls and combinations. A strategy goes beyond just options in that it is hopefully been back tested and shows consistent results over a long period of time, has a positive expected return, and it comes down to a set of guidelines or rules that you can follow to implement the strategy. That's the value of a strategy, but it's not, oh, I trade the road trip, but it is knowing all the tools and adjustments you can do when you trade a road trip to make that strategy work, that have been back tested and improved over time. Now, add on to strategies is adjustments. I should have made this gap here bigger, because most people say, my strategy says to buy an iron condor and sell it if it reaches the short strike and get out or expire it. That's well and good, and you can make a strategy that way. But adjustments are where you really start to have the depth of knowledge and understanding and insight that take you to the top of understanding options and options trading. Most strategies, including most that I've seen in books, don't talk about adjustments. They say, here's how you put the trade on, and it either works or it doesn't. But the facts are, if you have a set of tools you can use via adjustments, you can turn a strategy that might otherwise lose into a winner sometimes, or you can mitigate the losses, or you can hedge yourself and not be susceptible to such large drawdowns. Solid understanding of adjustments take you to that level. Now, most adjustments are simply a spread, like a debit spread, or add a butterfly, or add a calendar, or add an iron condor. There isn't really much else than that, you know. You can buy a future, you can buy shares of stock to partially hedge off your delta, all that kind of stuff. But most of them are simply simpler strategies or simpler spreads layered onto and added onto whatever strategy you're doing. So whenever I think about adjustment, if I'm doing, let's say I'm doing a debit spread to hedge to the downside, I think about, okay, I'm going to add negative delta. I'm going to add positive theta to this trade. How does that change the dynamics of my trade and fit in? Then this top layer I call self-actualization, and that's the takeoff on Maslow's hierarchy. Self-actualization, I don't know if I could define it by the book, but what it really means is you have insight and understanding and instinct that come into play when you're doing your options trading, and you can focus on the art a little bit more than mechanical rules because you know what you're doing, you know how they all work. This is what I call self-actualization, and I suggest that that's the highest level of knowledge of options trading. Okay, enough of that. Let's go on to the next slide. This slide you should commit to memory, okay? I'd go so far to say don't trade options if you don't know this quadrant or these four things. Because there's going to always be times when you're going to have to think about what is my obligation in this position? What is my right in this position? So I'm going to read them and talk about them briefly here. Let's start in this quadrant. If you buy a call, meaning you're long the call, then you have the right to buy the underlying vehicle at the strike price anytime before expiration date, if it's a stock. If it's an index, the idea is the same, but the actual specifics are a little bit different for an index because they're you can't do it before expiration. So if I buy a call on Amazon at 1700, I have the right between now and the time of expiration date to buy that stock for 1700 price. Even if it goes to 1900, I can buy it for 1700. That's the right that I have, and it's my choice. I can choose to exercise that right or not. If you are long a put, you have the right to sell the underlying at the strike price anytime before expiration date if it's a stock. These are called American options, and I made a little note down here. European style options, such as indexes, can only happen at expiration. But if it's American, they can be done at any time before expiration. Well, people have a hard time conceptualizing puts, but try to commit this to memory and try to think through some examples of what you have the right to do if you're long the put. Okay. If your strike price is 100 and the stock was at 105 and you buy a put, you pay something for that right, but then the stock goes down to 70, you can still sell it for 100. That's what the put gives you the right to do. Okay. Now when you're short, it changes things a little bit. When you sell a call, you're called being short the call. You have the obligation to sell the underlying at the strike price anytime before expiration date. And I say obligation because it's not your decision. Whoever bought the call from you is going to exercise their right and obligate you to sell your stock. It'll be done to you. You have no choice. You can have no control over whether or not this happens. And it'll happen when a call gets in the money by a long shot, long ways, and there's a dividend coming up, or it's in the money at expiration. Okay, so if I'm short a call at 100, stock goes up to 105, I'm going to get forced to sell my stock at 100, even though the price is 105, because whoever bought the call from me and was long of it said, the stock's at 105, but I have the right to buy it at 100, so I'm going to do that. And these two kind of are like opposite sides of the same thing. Okay? And then this one is the hardest to understand, but when you're short a put, you have the obligation to buy the underlying at the strike price anytime before expiration. So if you're short an in the money put at the strike of 100, let's say, and the price of stock is at 70, your put, somebody else can say, I'm going to make you buy it for 100 even though the price is 70, and you have a built-in $30 loss. That's your obligation when you're short a put. And I also want to clarify, long and short means net long or net short. Specifically, it means net position. So if you're short 2 calls, and if you have sold 2 calls and you've bought 3, you're net long 1 call. Okay. If you buy 1 call, then you're net long 1 call. That's why we say long and short instead of, I don't know, sold or bought, because sold or bought doesn't tell you what your net position is, but long and short do imply your net position. Okay. Yeah, I have a link down here for more than you want to know about this. So commit this quadrant to memory. This will help you in your trading. This is another little chart. I would say you don't have to commit this to memory, but it's useful to know a little bit. When you buy a call or when you buy a put, it has negative theta. Both of these are negative theta. Okay, so it's wasting away day by day if you're long. If you have positive theta. If you sell a call or your net short, you are going to have positive theta and negative theta. Delta can vary depending on where the strikes are. So, okay, read this slide, but you don't necessarily have to memorize that. Now, if you buy a long call, you're doing it because you either want to make money because the stock goes up, or you're hedging against something else that you have. I don't know. The computer's been telling me that all the time, and I don't have any idea what it's talking about for my Outlook settings. But anyway, I don't even use Outlook on this computer, so I'm going to ignore that. And this is what the graph looks like in Thinkorswim when you buy a long call. I think that's all I was really trying to show here. So let's go on to the next slide. When you're short a call, the graph looks like this. You're selling the call, and so if it goes out of the money to the downside, you're going to make all the premium that you sold. If it goes in the money, at some point you're going to hit break even, and some point you're going to lose money because of your obligation from your short call. Okay. I think I mentioned the 3 kinds of spreads. I won't dwell on this slide, except this is my point about adjustments or standalone trades. Parking trade, for example, is a vertical credit spread with puts. But you can use a vertical credit spread with puts as a hedge against some other strategy, like a butterfly or an M3 or a river trip or ABC strategy, whatever you're doing. And a lot of them do. A lot of them have that built in. They're very powerful adjustment strategies. Okay. This is a put debit spread. You can see it has profit to the downside. That might be what you're trying to do. If you buy a put debit spread, you're trying to hedge yourself against the downside. And a debit spread is a very good vehicle to do that with. Okay. I think I mentioned this stuff. The Weirdor is a Dan Harvey invention. It's basically like an iron condor or something with a straddle in the middle of it. It makes a weird graph, and that's where the word Weirdor came from. Strategies, what defines a strategy is a set of guidelines or rules that have been proven through backtesting. Now, not all strategies have been tested well enough, and so if you have somebody promoting a strategy that they're making a ton of money off, take a look and see if it has been back-tested and typical results shown through all different kinds of markets, through scaling up versus small size only. If a well-designed strategy, if someone has done the work and designed it well enough to be worthy of you purchasing it or whatever, it'll have been comprehensively backtested, not just kind of superficially. There are many people I can think of that are promoting strategies that have not been backtested, and they work until they don't work, and then you get mad and then you quit doing it. And it's better to know that your strategy has been thoroughly tested. Strategy with a higher expected return, such as the weekly calls on Amazon, have a high variability of results and higher risk tolerance. So generally speaking, shorter term trades or weeklies have higher risk and higher return than 1 month or 2 month trades. This is why when markets get volatile, if you increase your DTE when you open trades to 60, 70, 80, 90 days, you typically will have a trade that can handle the volatility easier than one that's shorter term. Okay, I think this is a cool little graph, and it's simple, but it's cool. If you do an iron condor, the graph looks like this one over here. You've got shorts here and longs, shorts here and longs, or even a condor. This is what it looks like. But all a butterfly is a condor where the shorts are the same strike. And so in the center, I've brought them closer and closer together, and here I've just put them at the same, and you can see now that we have a butterfly instead of a condor type trade. Okay, if you've ever been wondering if you should do iron condors or butterflies, well, you should just know they're related. Especially the closer the strikes are, they're related, and they'll have similar risks. Okay, this slide I'm going to go through. I think this is important. Adjustment skill is a golden skill in option strategy trading. I've seen people try to follow a strategy and they have a written set of rules, but it comes time to make an adjustment because the delta's too big or something and they don't know what to do. And if you're in that position, I would say don't trade it until you understand what your tools are and how you can use them to make a reasonable adjustment. Now the strategy might be written down. It says buy, put, debit, spread that straddles the money, so you get your delta down to 0. Okay, that's the rule. But what happens when you buy a put debit spread? You know, try to have the understanding that you're adding negative delta. You have profitability in that component of the trade to the downside. Try to understand more than just the rule saying, hey, you should buy a put debit spread. All strategies that you'll see can work. In fact, they have worked at some point for somebody, and that's why they are trying to promote them or sell them or present them. But your long-term results come down to how well you manage the risk when you're in a trade and how well you do your adjustments when you're in the trade. I firmly believe this. I think that if you don't understand your adjustments, your results are going to be riskier and more variable, for example. Manage risk, same thing. If you do a road trip, let's just use that, and you start doing all the adjustments because you understand them, you understand what they do, and your margin goes up to $10,000 for a 1-lot road trip. Okay, you have not managed your risk. To manage the trade, you've done the adjustments, but your risk has gone through the roof. What that means is your risk reward turns into some really bad numbers, and it also means if you went into max loss, it will take you a year of profitable trades to recover one loser because your risk got out of control. So how you manage your risk determines your long-term results. If you manage your risk so that the most you'll lose, your max loss number, is the same as the average expected return, then in theory, if you have a max loss, then you have 1 month trade, 1 more month to recover that loss and move on. That's kind of the idea in a nutshell. And I said that calls and spreads can be used. Oops, I wasn't ready to do that. Always know what and when your adjustment is going to be in all positions. And I guess I would add to that, always know ahead of time when you're going to make your adjustment and what it's going to be. I'll do that all the time. I'll look at the market and we'll say SPX is at 27.82 today. By the time it gets to 27.90, I need to make an adjustment. Then, number one, when it happens, I know what to do. I don't have to think about whether or not I need to do it. And number two, I can go out to Starbucks and sit around and talk all the time, and all I need to watch is to see if the market has hit 27.90. And then, if it does, all I have to do is execute my predetermined trade. It's a better way to trade. You should always know ahead of time what to do. And if you don't know ahead of time what you're going to do, then don't be in the trade. That's my best advice there. There are always several ways to adjust a strategy. Again, the rules will call for it, but for example, you could sell call credit spreads or you could put on a butterfly in certain situations. Which one should you do? They're both tools in the toolkit. They're both in the strategy, but under what conditions should you do one over the other? That's what I'm talking about here. You should have the knowledge of how they work and when to do them. And generally that comes down to know what the effect of the adjustment is on the Greeks. Because one of those might have negative delta and one might have positive delta, yet they're both viable adjustments. And so if you know the Greek effect of the adjustment and you know how that'll fit into your overall strategy, it'll help you decide which one you should do. Okay, this is just a simple example of a standard butterfly. This is not a road trip because it's balanced. You can see the expiration lines are balanced here. And I just worked up a butterfly. And let's say you're in this position, the market has gone up. Generally speaking, the bulk of adjustments in the bulk of strategies out there is basically to bracket the market and keep it in a favorable position to you. So we've talked before, but what that means is if you're in this situation, then you add another butterfly maybe up here somewhere, and you end up with a graph that looks like this. Now we're in a position where the P&L graph isn't sloping down so badly, and we're more squarely inside the tent, if that's where you want to be, depending on the strategy you're doing. Standard butterfly, that is where you want to be, so this is a good example of that. And then to take this one step further, I didn't show here, is if the market should keep going up, like maybe to here somewhere, then take off the original butterfly, and you'll be in another position where you're looking something like this. Goes up some more, put on another one above it, and then you'll be back in a position like this. So bracketing the market is basically walking up or walking down as the market happens to keep you in a favorable position in your strategy. That's really just about it for almost all adjustments. Okay. These are some golden rules, and I would ask you to commit this to memory. It'll help you. Whenever you're buying an option, whether it's long calls or the long component of a spread, you should be buying intrinsic value and selling extrinsic value. Okay? When let's see if I can do this without messing up my presentation. When we were looking at Amazon here, I have this column called extrinsic value. Let me see if you can see that there. Extrinsic value here. I think it's going to calculate. You can add that to your column. By the way you do that is click on this word here, and they have these predetermined column lists, or you can say customize, and then you have all these things that you can add. It's really powerful. You can add steadies, you can add probabilities, you can add theoretical stuff. You can add all kinds of cool stuff to this. I haven't tried all of these, but you can. So if you don't have extrinsic value and that's the only one you want to add, just come in here and say that and add item, and it comes over in here, and then hit OK to save it, and it'll show. I'll cancel that because I already have it. So when I first look at a covered call, I say, I want to sell the most extrinsic value I can. These are options I'm selling. I want to sell extrinsic value. But what better way than to look at this extrinsic value column and find out which one has the highest extrinsic value? And there it is. And that's why I picked the 1725 strike earlier in my Amazon example. Now, you don't have to do that. Another piece of fundamental knowledge you should have is that options at the money are going to have the highest extrinsic value. That's just how it works. They're also going to have pretty close to 50 delta. That's also how it works. So those are just two other ways of finding the highest extrinsic value. If I was buying one, remember I said that I would like to buy an 80 delta call? Remember I said that? Why is that? Because, let's go out just a month and let's find the 80 delta call. Here it is right here, 80 delta, 1665. Okay, because it has lower extrinsic value, and since we're buying it, we want to buy intrinsic value, not extrinsic value. Intrinsic value is the amount by which it's in the money. So you really could say 1723 minus 1665 is the intrinsic value of this option, which is 35, 55, about 58 or 59 points. Any value above that is extrinsic value. So we're buying much less extrinsic value than we're selling. This is a key fundamental thing when you're doing a spread or a trade. Buy intrinsic, sell extrinsic. Okay. It'll have lower theta because it has less dollars that need to waste away by the time expiration happens than one that has higher extrinsic value. Extrinsic is what wastes away with theta. And that's why I kind of have that little rule. If you're buying long option in a synthetic, try to buy the 80 delta or so. 80 delta turns out to be a pretty good high number. A little bit less if you're further out in time. A little bit more if you're earlier in time. But okay. Let me see if I can get back to my slide. Oh, I can. Good. I'm still qualified to use PowerPoint. Okay. Sell theta. Okay. As income traders, that's what we want. That's where you make your money. You're selling extrinsic value and it wastes away as theta day by day. So a piece of fundamental knowledge to help you do that is knowing what options have the highest theta. Does anybody know off the top of their head? Real quick, without thinking about it too long. It's the ones that are at the money. Just like extrinsic value. So if you had theta in here, and I do have theta in here, start looking down the list. Theta is expressed as a percent, basically. Well, it's not a percent. Sorry, I take that back. It's just a number. Here's at the money, it has the highest theta. Below it, it's less, and above it, it's less. And Thinkorswim will show you a graph of that if you wanted to see a graph, but it basically shows ones that are at the money have the highest theta. That means in all our strategies, if we're selling theta, we like to sell the ones closer to the money. Now, we do things like picking 10 or 13 delta for the shorts of the call credit spread to be as safe as possible. So again, it's a trade-off. We're trying to sell the highest theta, but the safest option that won't get hurt. I don't want to have to buy it back at a loss. I don't want to have to adjust it. I don't want to do anything. I really like to have it be. So that's the trade-off, and generally people converge on selling 10 to 15 delta shorts when they're doing a call credit spread or a put credit spread. Now I say generally because there's strategies that have it all across the board, and as long as the strategy is built to do it, that's great. But that's why we don't sell 5 delta calls, because there's enough premium or extrinsic value to waste away compared to the 10 or 15 delta ones. Okay. So let me get back to my slides. So it can be useful to say, ask yourself, what am I buying and selling here? Am I following the golden rule in this buy and sell combination? Now, directional traders tend to be negative theta traders because they're buying long calls or long puts, and when you buy them, they have negative theta. That's a completely different strategy, and they like it that way. But as income traders, we like negative theta. We like it wasting away. What am I trying to say? I think I said that backwards. We like positive theta, that's wasting away per day, and directional traders like negative theta, which hurts them day by day. Okay. Self-actualization, just a few things about that. An example, let me give you an example. Let's work up a butterfly on Amazon. And let's say it was going to be something similar to a road trip. I'm just guessing at some strikes here. Let's say it would be something like this. It might be, let's say 40 on the top and 60 on the bottom, 60 and 20. Okay. Okay, broken wing butterfly. Maybe not a road trip, but it's broken wing because this one's higher than the other one. Now, you may have come up with this because the rules say make you pick these strikes and come up with this. But here's the question. If I'm trying to buy this butterfly, will I get a better price, meaning cheaper, if the market goes up or down? Meaning, if I put in a price a little bit away from mid-price, if the market goes up, will it come into my mid-price and fill my order, or will it get further away from my price and never fill? This is something that could be useful to know or to memorize. And I honestly still have trouble with this in some situations. But generally speaking, let's compare two butterflies here. I'm going to take down all the strikes by 10 points. How about 20 points? I'm going to lower them all by 20 points. $1,600. Now let's uncheck the first one. Well, we didn't really need to do that. Which one is cheaper? Okay. Well, the lower strike one is cheaper. Why is that? Because we're further out of the money than we are with this other one on the upside. So this butterfly is going to come down in price if the market goes up. You could look at delta and come to the same conclusion. If I already own this butterfly and it has negative delta, then as the market goes down, it will go in my favor. I'll have higher profitability. If the market goes up, it'll go against me. But that's if I already own it. If I don't own it, it'll go in my favor as the market goes up because it has negative delta. So I hope I explained that well. After years of trying to think about this, I still have to pause and think about it. But I should be able to sit down and say right off the top of my head, yep, it needs to go up to get a fill on that order. This is a simple example, but if you had a butterfly with some weird strikes or some, diagonal component to it or something, this can get really complicated, but it could be useful to know what it'll take to get an order filled. Okay, I think I have a question. Let's see. Chat. Okay, Robert, up due to lower vega. Now that's a good point. These butterflies have negative vega, which means as the market goes up, they will go up in price. But if they have negative delta, it means as the market go up, they go down in price. So which is it? And the answer is we don't know. There's no graphical good way to know which one's going to prevail. However, I would suggest, from having done this for a long time, that in the very short-term time frame, like minutes, when you're trying to put this order on, the Vega effect probably won't matter very much, and it's the delta that will determine how this goes. Now, that depends, right? I mean, if while you're doing this is some big news event, you know, Vega will probably take over. So that's a very good point. I tend to ignore Vega when I'm thinking about this. Because normally I'm trying to get a fill within minutes. And I just want to know if a small uptick or a small downtick is what it's going to take to get my order filled. Okay. All right, let's go back to my slide. Oh, did I have another question? Yeah, Robert, I don't know for sure, but I suspect in the very short time frame, Vega doesn't matter so much. I think you're right, thinking longer term. Okay, let me get my slide back. What else do I have on here? These last 2 points are good points. I think I have an example that I can show you. Let's pick this one. And let's go to SPX. And let's start over because I might have had some other junk in there, so let me reload that. Okay. Now this looks like a simple butterfly. Okay, but look at all these trades that have gone into it. There's been a lot of work done on this trade. You can end up sometimes with 10 or 15 different strikes in the component of your trade. I think I have an example. Let's see here. Let's see if I have another example to show you. Oh, I did put it in PowerPoint. Okay, let's bring this up for just a minute. I got to wrap this up. We're getting out of time. But let's say that you look in your monitor page and you had this. Okay, this is based on a real example that I had about a year ago, almost a year ago. You know, all these strikes, all these different quantities. What the heck is this? It's a butterfly. It was a road trip. But do you see the 20 by 40 by 20 butterfly in there? No. So when I talk about self-actualization, part of that would be the skill to look at this and say, well, looks like I've got a lot of shorts here and longs here, so I could take a 12, 24, 12 out of this and have 4 of these left, and then I could take 4 of those and 4 of these and 8 of these and have, you know, wipe out one of these strikes. Then I could start doing some verticals and take out some of these at a time. It's the ability to look at this and find out what it's going to take to close this position. And if I remember right, it took about 8 trades to close this position. This was a particularly bad one that I ended up with. That's what I wanted to show you there. So let's get back to my presentation. I think I'm almost done. Let's see. Where is the let's see here. Okay, here we are. This is where we were. Yeah, that was my last slide. Anyway, I wanted to go through that. I think there's some good information in there. And I find it useful to review some of this stuff myself periodically just to make sure I'm remembering it all, and that comes into the trade. Okay. Questions. So let's see here. Let me dump this. What do you think about trading the weekly VXX for the next week, selling 32 and buying 36? Well, let's look at it briefly. Here's the option chain. You're talking about the 22 June, okay? And you're talking about selling 32 and buying 36. That'd be this. I think that's what you're talking about. This is a call credit spread. Where's VXX? VXX is 31. There isn't much room to the upside before you get into loss, even at expiration. That's neither good nor bad. It's just I'm just observing that there isn't much room to the upside, which means if we have a downturn in the market, this trade probably isn't going to work. But if we stay where we are or go up, it could be a profitable trade. So I would hope, Fez, that you are choosing those strikes based on some criteria. Maybe you're doing it based on what Russell Rose presented last fall. I haven't reviewed that for a while. And if you have, and if that's a strategy that you're following that has good long-term results, then this could be a good trade. If you're just trying to pick high extrinsic value to sell, I'm not sure this is going to be the best trade. Getting some decent credit for VXX, but for example, if you sold a 36 and bought a 40, you have more room to the upside as protection, even though you have less potential profit in the trade. So it's always a trade-off when you're doing credit spreads like this. So I can neither say it's a good or a bad trade. All I can say is those are the trade-offs, and if you're following a strategy that has been proven and works, then that might be your trade. Okay. Right. I'm gonna stop there. Let's see. Oh, great. I'm glad you guys enjoyed this and got some good things. I hope you got some good things out of it. I think it's a very good PowerPoint that I had there, and I hang on to it. ATR for VXX, so that means we would want to see a chart. And we probably want to see maybe this chart. Nope, I don't have ATR on that chart. Let's see. I have not this one. Here's ATR. So a 14-day, or I'm sorry, a 5-day ATR on. Sorry, change the symbol on me. 5-day ATR on this is about 1.3 or 1.4. That means that 32, 36 spread. Yeah, I don't know. That's awful tight. That's tighter than I would like it if it was me. Yeah, VXX has a bias to going down. That doesn't mean it will in any particular short-term time frame. So I don't know. I haven't traded VXX for a while, so I'm not really on top of it lately. Okay, guys, I think it's time for me to go hit the gym. So thank you. I enjoyed this, and I hope you did too. And as always, send me questions if you want to get into a particular subject or have questions. And we'll see you all next week.